You're with us on BTTV and joining us today, our market guru Chakri Lokapriya. Let's get in conversation with him on all the turmoil at the end of the year. Chakri, this is most unanticipated when you look at the timing. We're heading in for the last week of December 2022. It's not usually a time when we see people react so heavily, and we saw a complete meltdown on Friday. What do you think is really happening here?
Indeed, you're absolutely right. What the gains that were built on in the last few weeks was all undone in a matter of maybe two or three trading sessions. And this is clearly a case of an extreme fear and largely probably unfounded, at least on a fundamental basis. Partly it was the COVID fears in China, partly prior to that, few days prior to that was the US interest rates. The US interest rates bit is very highly telegraphed incident. So one shouldn't really expect anything. Interest rates are expected to continue to rise in the US. There will be some, they will reach 5.25. That's already been discounted in the market. So I think the second thing unknown was the COVID fear. But at least if you look at the numbers in the large countries, including India, COVID numbers are not going up so far. And so far, it seems to be overblown. Against this backdrop, lots of stocks and sectors have corrected dramatically. Index has corrected about 5%. Individual stocks have corrected more than 20%. I clearly think it's time to buy on a fundamental basis.
Okay, great. So you're still saying buy in. Let's take this one by one, Chakri. First of all, given the uncertain backdrop, do you feel India is still relatively insulated? Let's keep COVID out of the way for a moment, because that'll upset the whole world naturally. But when it comes to the rate hike environment across the world and the kind of impact that's being expected on growth and the macroeconomy, till now the narrative has been that India is relatively insulated. While those growth forecasts may have been trimmed, they're still looking pretty decent compared to what we're seeing relatively globally. Are you still in line with that?
See, I think clearly the markets are never completely insulated from each other. But what's you're right about India's perspective is the growth and the inflation. Now, if you look at UK, inflation is running at 10, 11% versus hardly any earnings growth for the index. You look at the US, inflation is at about 6, 7%. Again, for earnings growth, which is still existent about single digits kind of thing. If you look at India, inflation is about 7, 8% with earnings growth of 12, 14% at an index level. So this tells you that there is that margin of safety, because if you look at historical multiples, Indian index multiples, India still trades at a 10%, 10 to 12% discount, depending on the index, to the 10-year averages. So which means with a 12% growth, with a discount to the averages, and the earnings taking into account rising interest rates as well as a 6, 7% inflation, I think growth is intact. If anything, once we see the peak of interest rates, you will see an earnings acceleration.
Okay, so are you seeing any concerns with regards to any supply side issues that may come up? We've been anticipating, of course, a huge squeeze on margins across the board. So when you are talking about earnings realigning, are there particular pockets where you feel we're going to see evidence of this?
I think, some of the sectors which have corrected, like, for example, consumer discretion,
Okay.
hotel stocks, tire stocks, banks, are, I think, at the core of showing good growth, protections, valuation, as well as there is no real moderation in their earnings growth. And if anything, it's the opposite. November, the month, there was some amount of retail slowdown and that markets extrapolated. But if you look at December, there's again been an acceleration. So I think, all those pockets, which is consumer discretionary, banks, including cement, are looking good.
The fact that we are continuing to see robust demand, even if you look at, let's say, travel, hospitality, despite the increase in prices, we're still seeing a pretty resilient demand scenario.
Indeed, absolutely. We have done some few channel checks, and as a part of work, I've traveled quite a number of cities over the last 1 week or so. Hotel prices, restaurant demands, airlines, all prices are really up there. That shows the demand is extremely robust. And so I think this resilience comes from, to begin with, Indian consumer was not leveraged. Indian corporate has deleveraged in the last 3 years. Banks have fixed their NPAs, are in a position to lend. This is like a Goldilocks scenario actually to think of it in terms of as and when we see stability and when these third-party risks come, outlier risks like certain COVID scares. I think other than that, looking very strong.
Okay, what about on the capex end of it? Do you still see those plans being, implemented? How do you feel companies will respond? Have you got any early indicators? Because we've been talking about this for the last 6 months, but are things looking any different given the tightening scenario at the end of the year?
I think that's a good point. I think capex will still take some time. Both road construction as well as EPC is slightly below where it normally is, and that's clearly simply because of if you look at India, if you look at Indian banks. So on the opposite side, banks benefit because 60% plus of PSU bank loans are on floating rate, which means in a rising interest rate environment, they benefit from higher spreads. Now, the other end of the spectrum, which you asked, which is the companies which are borrowing, which is for capex. Now, they'd like to see a peak of interest rates so that they can base their plans, their long-term projections, capex plans, as the cost of funds. So I think as RBI reaches this peak of interest rates, that's when we'll see capex picking up.
Okay, we're heading towards the budget as well, Chakri. So not long to go, just about a month. And usually at this time, we start to see certain pockets pick up, which we're already seeing, of course, with certain stops being given to, particular sectors. But going forward, what are you anticipating? What's going to be really big to watch out for this year when it comes to the budget?
I think the budget actually has to be positive for the consumer and for the corporate, especially given that you're going A, into an election scenario into the following year, and B, coming out of COVID. This was supposed to have been, 22 was supposed to have been the recovery year, but then you had the Ukraine war and external shocks, which actually pulled down lots of plans by countries, including India included, on their capex, etc., because nobody expected a Ukraine war. That led to high inflation. High inflation led to slowdown of capex. So all these confluence of factors had a snowballing effect. And so they've all things can't get worse from where they are today in terms of interest rates and inflation next year. So that will largely which means cement as a sector will benefit because construction picks up ahead of elections. Then you'll see capex, which means that should pick up. If all these things pick up, the most initial thing, a sector to benefit is banks because they lend to corporate, consumer, and the government.
Okay, I love the way that you've broken this up for us, Chakri. So cement, of course, continues to be key. Banks, financials, consumer, clearly on your radar. What are the avoids? Commodities, metals, maybe oil and gas, but metals in particular. What else would be on your avoid list? I mean, IT, yes, it's taken a beating this year, but would they still be in your basket, some of those heavyweights?
Some of the avoids would probably be still the power sector, again, for the opposite reason. In an election year, they wouldn't try to reject the power prices, which is, so stay away from that. Telecom has had its run. As 5G's capex rolls out, incrementally, that will be a drag on the sector. Metals, while the outlook is kind of subdued, the valuations have also significantly corrected. So, which means the top names, Tata, Hindalco, Tata Steel, and JSP should actually benefit from a valuation perspective. When you mentioned IT as a sector, even if there is a slowdown in contracts, which means top line, still the companies have enough margin levers because of falling rupee, EBITDA margin expansion, falling attrition, which will help them to generate a 14-15% earnings growth. So given that valuations have corrected already for the IT sector, I think IT looks good, the front line, TechM, Infosys, TCS, etc.
Okay, fair enough. There has been a trend towards sticking towards the large caps and the safer bets, so to say, in the market, even across these sectors. Would you follow that? Would you be looking for some of those pickings in the broader markets, or would you also suggest staying safe at least for the next few months? Because if we're so bullish and positive on India, maybe this would be a good time to buy some of those mid-cap plays.
Indeed, I think it is the time to buy India and also the broader market. You take, very big banks like Bank of India, Union Bank, Canara Bank. I mean, Bank of India has a 5 lakh crore book, so it's not broader market in terms of the sheer size of the bank. And it's cleaned itself up. The NPAs are under control.
Right.
Cost of has come down, and the bank trades at less than half a time's book. Punjab National Bank, a market leader at one point, due to well-known past mistakes, stock is trading at under half a time book.
Yeah.
Similar story with Canara Bank. So if you look at SRF, leader in the chemical space, chemical industry space, one of the market leaders worldwide, it has also corrected. So within the broader market, there are sufficient pockets which have overcorrected, which clearly warrant immediate buying.
All right, so that's diving a little bit more into those financials. You didn't mention the PSU. I mean, in the sense, private versus PSU, would you say it really is stock specific, or would you avoid the PSU names altogether? Because there has been a little bit of back and forth on that front.
PSU banks clearly would not, for the reasons just discussed in terms of valuations, risk reward is clearly on your side for an easy 40-50% of certain levels. On the other hand, if you look at the PSUs like the Bharat, the defense names, these stocks have done well and rightfully so, but valuations are kind of reflect that. So those banks, those companies will Bharat Electronics, HA will continue to tread water, but not really fall, because their outlook is very strong.
Awesome. Great to identify some more of those picks. Chakri, when it comes to auto, and just to close off with that today, but does that also fall in your consumer basket? Is anything in auto on your radar?
Yeah, within auto, I think, the two-wheelers, TVS Industries, Hero MotoCorp, all these companies are seeing robust demand. I think, therefore, earnings estimates going into the next quarter will look really good. And correspondingly, auto ancillaries. If you look at the tire companies, their main raw material is crude related. Crude is down 30-odd%. So they'll have a margin boost. There is a volume boost you're seeing in autos. Companies like JK Tire trade at about 6-7 times earnings forward. Which means their ROEs will double going forward. So against this backdrop, tires and auto companies look good.
All right, fantastic. Chakri, great speaking with you today, and also getting a flavor of the market and where some of those value opportunities are as we head in towards a close to a very, very eventful year. Let's see what the early signs in 2023 have in store for us. Thanks so much for joining us today.
Thank you very much for having me.
If you like the video, do like, comment, share and subscribe.